The increase in oil supply from US shale producers doesn't seem to have pushed the global demand-supply balance into surplus as some had expected. Indeed, as our next guest will say, there's a deficit of oil production and it could get worse. How can we trade it? Well, joining us now is the fund manager of the Junior Oils Trust, Angelos Damaskos. Welcome. I want to take a look at a couple of stocks in your fund in just a moment, those that you're looking at with some interest. But let's go first of all with a look at this deficit. We've spoken to you before about the drop in oil prices that we've seen a couple of years ago, and you were talking then about the fact that companies just were not going to invest. Where are we going from where we are at the moment?
Well, I think what we envisaged a few years back, Jeremy, when we spoke about it, is happening now because there was a dearth of capital expenditure in the industry, as one would have expected, following the collapse in oil prices and many companies going bankrupt. So the capital expenditure that was targeted in exploration and development of frontier projects has been cut or shelved. Perhaps in some cases indefinitely. And we believe that this is what has pushed or is pushing now the market into a deficit, because demand has continued to grow very steadily. And as some very credible research shows, we tipped into a deficit late last year, and we expect to be in a much deeper deficit this year and for many years to come. And that is notwithstanding the very rapid growth we have seen coming out of North America, because the shale producers have accelerated their drilling. It's basically a manufacturing process. They know where the oil is, how much it costs to drill and extract. So it's a fairly easy decision to raise production once the prices recover. And this is what we are seeing. But nevertheless, we don't see this supply coming out of North America filling the gap between supply and demand globally.
Okay, I want to talk about OPEC in regard to that in just a minute. But let's go back to the chart very quickly and take a look at the last time we had a deficit, a large deficit, was 2011. Here we are now in 2018 with a smaller deficit. But you're projecting, or the projections are from this BMI research, is that by 2022 we could be as low as where we were back in 2011. Now, oil prices in 2011 were $113 a barrel. Do you think then that oil is due to peak above $100 a barrel sometime in the next couple of years? Are you fully expecting that?
It's hard to see oil going back above $100, but nothing, is unexpected in this world. The point is that we are now on a steady rising trend because we have this supply deficit. The question is, on the margins, what will be OPEC's reaction? Are they likely to increase their quotas and supply additional oil to the market, therefore correct this deficit somewhat? Or is this dearth of exploration and development expenditure going to be much more severe than OPEC can actually produce? Because OPEC, we know, doesn't have that much spare capacity available.
So you're saying that OPEC may not actually be able to fill the gap?
That's right.
Okay, all right, let's move on then and take a look in some more detail about where the demand is coming through from, because we're hearing that inventories are dropping. We know that it's been sucked out of the system. Where is the big demand in the oil sector at the moment?
In fact, with regard to inventories, we have seen the sharpest ever drawdown of inventories in the year to date, in the last 12 months rather. And that is, again, on the back of this North American growth in production. So the growth in demand comes from where we have always expected it to come, which is the fast-growing Asian economies, particularly China and India. And I want to point out here the chart about Indian oil imports, and particularly the yellow line that shows the net imports. Because India does also produce oil domestically. And it shows this very dramatic and rapid rise of imports. And that is on the back of a very fast-growing Indian economy and a newly developing middle class of people that need a lot more energy to establish a better standard of life. We know that energy consumption is a direct component of a growth in any economy, and we expect this to continue. So China and India really demand much more oil than the world can supply. And the question is, how long will it take before we can find that additional oil?
Okay, let's take a look at the performance of some of the oil stocks in the global oil energy index. I think you've got a chart here which shows that we are at recent lows. Explain what's going on here.
This is the chart of a global energy exchange traded fund. And it does show that even though the integrated majors, for example, the Shells, the BPs of this world, have done much better than the whole universe, the entire sector of energy equities has underperformed dramatically and is now again at extremely oversold relative strength index. Now, this is very interesting that is happening on the back of very strong oil prices now. We are double the levels where we were in 2016, and we show a rising trend. So investors still continue to shun the global energy share universe in preference for other stocks, including the integrated majors.
Okay, let's take a look now from your perspective as a small cap fund manager. I think the next chart shows that your top 10 holdings, which you have in your junior oils trust. We've spoken to you about these before, and I know some of these will be familiar with many people that have looked at these videos over the years. In terms of the performance of your fund, first of all, how are things going? Is it mirroring this deficit that we're seeing build up?
Well, interestingly, we have done a lot better than the overall energy sector. And the reason for that is that we have been fortunate enough to have some very successful picks in our portfolio that have outperformed the energy sector and in fact, most of our portfolio, which have grown to such big weights. And in certain situations, such as Carnarvon, Serica, Quester, and some others, we have taken some profits, as is our normal standard of operation, and we have recirculated that capital into some new opportunities that we think are highly prospective and could be the next strong performers.
Which ones are you talking about, particularly the new ones?
Well, I wanted to draw the reference to two particular holdings that are very recent and have started performing extremely well. And the first one is a very small company, only about £25 million market cap, called Highlands Natural Resources. And that is a shale producer. It operates in West Denver in Colorado, and it has produced some remarkable results from its drilling and production program. But most recently secured a farming deal with Renegade, which is a very large company that will enable to drill up to another 24 wells with very preferential terms. And that could help it accelerate its production growth much faster. In addition to that, they benefit from a proprietary technology that controls the fracking fluids, the fracking process of these wells. So they have a competitive advantage built into their overall business operation, if you like. And I think they have excellent prospects. So especially as the sector comes back into favor and re-rates, they will be very well positioned.
Markets tend to price in future activity. Why in that case, bringing this chart back up again, why are we languishing at 22.6 when we've been at all the way up here, well, I think about 70 at one point, the reading here a couple of years ago?
Yes, the historical operation is a long time ago, and that was a different period for oil stocks and oil shares. But I think they have been restructured and taken, installed some new management and acquired some new assets in the last year or so.
So it's a transformed company.
It's a transformed company, and I believe now it has much better process. As a producer, we are not longer looking for oil. We know the reserves they have. It's a matter of accelerating production.
So at these sort of prices, as a fund manager, what are you expecting it to achieve in terms of share price activity?
Well, I don't like to make forecasts for valuation, but I think it's extremely undervalued. If you look at the peer group, it should be a multiple of where they are trading now. So I'm very optimistic for their performance.
I'm interested in your second pick. It's actually outside of your top 10, President Energy. Now, we have spoken to another interviewee on this very subject, actually, and I'm interested to see your take on it, because President, as I said, doesn't appear yet in the top 10, but it's one of your new additions, isn't it?
That's right. It's one of the new additions, and it is slightly below the 4% or so threshold that we have for our top 10 holdings. And the reason for that is that we have historically been very cautious about Argentina and the political risks in the territory, in the region. So President Energy is our new exposure, and perhaps the sole exposure to Argentina. because they have they have done a transformative deal about 6 months ago, and they raised capital in the process to finance that deal, and we participated in that funding. And the reason we did so is that we believe not only that they acquired assets at extremely attractive metrics, but also they have tremendous prospects to grow production and become a very meaningful player in Argentina. Now, Argentina has changed dramatically in the last few years with the new government and the settlement of international debt issues. So we think that the economy has turned around, so there is some promise there, but we are still relatively cautious and will only take exposure to something that we think offers tremendous upside with relatively low downside. And this is what President does.
Good. Okay, we've got to leave it there, but thanks indeed for joining us. Your 2 picks from your fund, the Junior Oils Trust. That's the fund manager. From that fund, that's Angelos Damaskos from Sector Investment Managers.